So welcome to tonight's session on picking direction in any market. It's the second part of our three-part series that pretty much goes through from A to Z how to become a trader. If you didn't catch the first session and you haven't had an opportunity to listen to the recording of it, you might be wondering who we are. And it's always good to know who your presenters are, and we're from Traders Circle. Now, Traders Circle, the other side of the business is Emerald Financial. And the differences between the two is that Traders Circle mainly focuses on traders, and Emerald Financial mainly focuses on more medium to longer term investors, right? In the previous webcast, we did differentiate between those two terms, a trader versus an investor. A trader is obviously someone perhaps looking more for income generation and being fairly active in their buying and selling, whereas a medium term investor is more about buying and accumulating and looking for capital growth, right? Trader Circle's been around for quite a long time. We were established in 2005, and our sole purpose is to support traders. Right? That's all we really want to do here is that we're a trading desk. We've got plenty of experience, plenty of knowledge, and what we want to be able to do is support you as traders, essentially, right? Help you make decisions, help you price up trades, help you keep on top of the trades you're in, give you trade ideas, right? Basically, act as a backup towards your trading. We became one of the busier options trading desks in Australia, right? So we love to trade derivatives such as options, and we will cover that in the third part of the webcast next Thursday. And we also run education. So we don't want to trade for you. It's not one of those scenarios where you give us your money and then we do some trading for you. It's not that at all. What we'd rather do is educate you, get you up to scratch, get you on the same page as us, and then give you advice and help you trade, essentially. So we do run education courses for beginners all the way through to quite seasoned traders. Our method is simply to teach you step-by-step how to trade the Australian market, provide the support, tools, and trade ideas, and then really hold your hand as you transition to trading the live market. Now, my name is Caro Cornips. It should be a familiar name to some of you, a new name to others. And I've been with the business for about 8 years, maybe 9 years now. I don't know, you kind of lose track, right? I'm an advisor. I sit on the trading desk. And so the large part of my job is to help clients with their trading, right? Again, that includes helping them price up trades, help them keep on top of the positions that they're in, give them trading ideas, basically provide a lot of service around their trading. My other job is that I help educate. So the reason why I'm doing this webcast tonight alongside Tim, who I'll introduce in a moment, is because a good portion of my job is really about educating people who've come along and done the workshop. So with all our education courses, you get your own personal trainer, and I'm the head trainer, right? So I'm here to really answer all your questions, make sure you're not making those silly mistakes that you're prone to making as a beginner, and to really help guide you and get you to where you want to be with your trading, right? So education is something I've been doing for quite some time, as well as practice, obviously, and hence why I'm going to be running through the education with you tonight. Tim, on the other hand, is the head trader, or the head of the trading desk is another way of saying that. He's been with the business for, I think, maybe 9, 10 years, a very long time as well, like a lot of people in the business. And basically, he's kind of like my boss, right? So hopefully I do a good job tonight. He started actually as a client. So he came along and did some education, left his job, started trading, and then we offered him a job to become a trainer, which is my job now, and an advisor. Eventually, the co-founder of Traders Circle, Carlo Castellano, who founded the business, he retired, or semi-retired, I should say, and Tim took over and became the head of the trading desk. So again, he spends a large portion of his day helping clients with their positions, right? Helping them price up trades, looking after very sophisticated traders. But being a small business with only 10 to 12 of us in the office, we have a lot of fingers in different pies. So Tim actually works in a lot of different areas, but his strength, his focus, where he dominates is obviously on the trading desk. So just a little bit about information about who you're hearing from tonight, plenty of knowledge. So if you've got any kind of obscure questions, ones that are a bit hairy perhaps, whatever it is, feel free to type them in and we'll address them as best we can. So tonight's agenda is fairly simple. We're going to run through technical analysis, when to get in and out, and we're going to talk about short-term versus long-term trading, right? Fairly simple. Each of those topics will be broken down quite heavily. So I hope you've got your thinking caps on. There's a lot of content to go through tonight. We're going to try and keep it to an hour. Forgive us if we go over time. We're prone to doing it. There's just a lot that we like to cover because we think it's important. We're not going to cover everything that we can tonight, obviously, right? We run courses on this for a very good reason. We have plenty of videos out there that we give to our clients in order to help them refresh. It's not going to be possible to cover every aspect of what we want to cover tonight in 1 hour. It's just not going to happen. So I think that I've done a good job. I've picked out what I think are the necessary things to understand and the things that you should be focusing on. So what you can do by the end of this presentation is hopefully go out there and start doing your research and focus on things that you need to learn about. We run education that you can come and sign up for and do with us. And if you want to, it's not necessary. But I guess it's just important to understand what you need to go and learn and then to go and get that information somehow, right? Part 3 next week is going to be about strategy and trade management. So we're going to be talking about trading different market conditions, which, makes a great deal of sense when you're a trader, right? You can't just buy low and sell high. That can't be your only strategy because the market doesn't always go up. And I think we have seen that earlier this year, right? It's a perfectly good example. So you've got to be able to trade different market conditions, bullish markets, bearish markets, sideways markets, volatile markets, right? And so we're going to show you how we tackle those different scenarios and how we profit from them. The way that we do it is by using derivatives. And so we're going to go into that. Now we're going to touch on it tonight. Ever so slightly, right? So that you guys got an idea as to what's coming next week. But we're going to be talking about mini warrants and options, the two main type of derivatives that we like to trade on our market in order to profit from our view. And then finally, we're going to cover one of, I guess, the pillars of trading, which is managing your risk, right? Managing your trades. So the 3 pillars are picking direction, strategy, and managing your risk, right? And in the next session, we're going to be going through strategy and managing your risk. Picking direction gets its own webinar because it's such a huge topic and arguably the most important topic, arguably. Last week, just as a quick recap, if you didn't watch the webinar, if you haven't had the chance to sit down and watch the recording, it was basically an introduction in a lot of ways. It was about introducing the core skills that you need in order to be a successful trader. And really, that's about it. So we covered the core topics. We covered picking direction, choosing the right strategy, and managing your risk. We also covered things around portfolios, right? What type of platforms are out there and ones that you should consider using. And kind of all those general information, frequently asked questions that beginners have. All right, so if you haven't had a chance to watch it, please go back and have a look after this webcast. Now, before I jump into the guts of it, it's important to understand that any advice contained in this presentation is general only. So it's not tailored to your personal circumstances, and you therefore need to decide for yourself as to whether it's appropriate to you. All right. So tonight, it's all about picking direction, right? And you can basically sum up the analysis of a stock into 2 major types of analysis. I'm sure there's someone who wants to argue with me on this, but this is, in a simple sense, the 2 major forms, technical analysis and fundamental analysis. Last week, I did cover this, right? But just to recap, fundamental analysis is more about looking at the company, their balance sheet, how well they're performing, the health of the business, how much money they're making, what their expenses are like, how much debt they have, how much money did they make today or this year compared to last year, and what are they expected to make next year, right? These are basically number crunches, guys. Fundamental analysis are geeks who sit in their basement and look at hardcore numbers. Right? I'm just joking. We do fundamental analysis here as well. But fundamental analysis is actually a little bit more tailored towards longer term views, right? It's that fundamental numbers play out over a longer period of time. Now, what does the word longer mean? Good question. I would say that you're looking at a 1 to 10 year outlook when you start applying fundamental analysis, right? Not a 1 day or 5 minutes to 1 week or 1 month outlook, okay? Now, fundamental analysis, considering that, is probably not the best tool for analysis when it comes to shorter term styles of trading. Instead, technical analysis is. And technical analysis is far simpler, in my opinion, which is great because it means my life is easier, right? It so happens that the simpler form of analysis is the one that you should be using for shorter term trading. Technical analysis is predominantly built around reading charts, right? It's about reading past price data represented as a graph, right? Whether it be a bar chart or a line chart, and I'll go through that in a moment, to understand where you think the stock is going. So you're reading past price movements to predict future price movements. Okay, and the simile or the metaphor that I like to use is that technical analysis is like painting, right? You have a blank canvas, which is a chart, and then you apply technical analysis principles like artistic principles onto the canvas until an image is formed, right? And those principles, when it comes to technical analysis, are in front of you. There's support and resistance levels, trends and counter trends, technical patterns, entry and exit signals, and mathematical indicators. Now, you can add more to that if you want, but I'm not going to tonight, right? But as we apply these basic principles to our canvas, like a painter does trying to create a piece of art, the image becomes clearer and clearer. Okay, so it's not about doing one of them, right? It's about doing all of them in a step-by-step approach. Does that make sense to everyone? Now, this is what a typical chart looks like. I had this slide up last presentation, right? We didn't go into technical analysis very heavily, which I'm going to tonight, obviously. But this is a chart that I had up, and this is the chart of the XJO, which is the ASX 200. It's the index of our market. And you can see it looks kind of messy, right? It's not a very pretty chart. There's a lot of stuff going on. You've got the underlying chart here, which is represented by the bars, and you've got a line here, another line there, another line there. There's a green line, a blue line, a red line. There's that line there. There's funny little lines down here, and then there's this weird looking graph down here as well. There's a lot going on. It's messy. So what I'm going to do tonight is I'm going to help you decipher this chart in a very basic way. So this is a bar chart, right? We're going to start nice and simple. A lot of you might be used to a line chart. When you like Google a stock, like you type in CBA, ASX, it's going to come up with a line chart typically, right? We don't use line charts because they have very limited amounts of information. Instead, what we like to use are bar charts. Now, you can also use a candlestick chart if you wish, right? And some of you online will be familiar with a candlestick chart. It's a popular type of chart that a lot of people like to use. We prefer bar charts. It shows exactly the same information. It's just displayed in a different way. It's honestly just an aesthetic thing, right? Same information, just displayed slightly different. It's not going to give you it's not going to give you an edge using a candlestick over a bar or a bar over a candlestick. It's just whatever you prefer. The point is that we use these over line charts is because they actually do display more information. And if we're going to make judgments on what the future is going to bring, we want that information, right? We want to be able to analyze that information. Each bar of a bar chart has the open on the left-hand side, the high of the day, the low of the day, and the closing price or the current price, right? So you could have one bar representing one day, which is what you typically look at. But you could also have one bar representing 1 week, right? Where it has the opening price on the Monday. It has the low the stock is traded at during that week. It has the high the stock is traded at during that week. And it also has the closing price that the share closed on the Friday night, right? But you could also do the same thing for a monthly chart, right? Each bar could represent a month. Now, again, as traders, we typically look at the daily chart, almost always look at a daily chart. But to be honest, sometimes we do look at a weekly or monthly chart, right? So hopefully that makes sense to everyone. Now, we're going to jump straight into one of the core principles, if not the core principle of technical analysis. A lot of things basically revolve around resistance and support. And if we think about this logically, it's because if we're looking at past price data in order to predict future price data, then acknowledging where a stock has gone up and then come down, or gone down and then come up, helps us predict the future, doesn't it? It's a piece of information the stock has done in the past that it may do again in the future. So very simply put, a resistance level, as the name describes, is when selling comes in after reaching a certain price point. So the stock's traveling up and up and up. It gets to a particular price point and then starts to sell off. Support's the opposite. And as the name indicates, buying support comes in after reaching a certain point. So buying comes in to support the stock from falling further. So it's falling, 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 reaches a particular price point, and then bounces up and starts going up. If the stock's done this in the past, there's a fair chance it does it again in the future. Does that make sense? So here's an example of a resistance, and this is an example that I pulled from the market today. This is the ASX 200. This is the XGO. When someone says to you, "Oh, the market's falling today," or "We're in a bull market," they're talking about this chart. All right, this is the Australian market. This is the XGO, the ASX 200, and you can see every time the index gets to roughly 61.85, as you can see what this line represents, the stock, the index, I should say, turns around. Now, it might turn around only briefly. It might have an excessive fall. But every time it gets to this level so far, the past 4 times, it has failed to get through. So if the index, gets up to 61.85 again, roughly, in my mind, I'm thinking, well, there's a very good chance that it falls from here, or at least that it doesn't get through. And having that information is one piece of the puzzle that'll allow me to trade and speculate. All right? So resistance. Now support. You can see on the exact same chart, the XJO, you can see there's a support level here at roughly, call it 57.70, thereabouts. Now on an index, you have to be a little bit more rough. And if you speak to someone who's been doing technical analysis for a while, they'll tell you it's an art as well as a science in some ways. I don't know how true that is, but you can't be too exact with your lines. It also depends how thick your line is as well, right? But roughly speaking, when the XJO gets down to these levels, it has turned around. It hasn't wanted to fall further than that, right? Historically, which means that if we do get down to that level again, then I'm thinking to myself, well, there's a very good chance that the stock rebounds from here and travels higher. And again, that's another piece of the puzzle that I can use to speculate on the future direction of the stock, or in this case, the index. Now, the funny thing about support and resistance is that they can swap roles, right? A resistance can become a support can become a resistance. And when we're trading, what we actually prefer to do is look for levels that are what you call key, right? And a key level is a support/resistance that has had multiple turnarounds in the past. If you take into account every single support level, every single resistance level that has only 1 touch point or even 2 touch points, I can promise you'll never trade, right? So the idea here is to look for levels that are what you call key. Now, I showed you the 61.85 level up here. That's a key level. It's got 4 touch points. It's the top of the market at this stage, post our falls anyway. And I've showed you roughly 57.70 or roughly around there as the lows that we haven't really wanted to go below since, say, June, right? But there's also another level through here at 6,000 roughly, 59.97, we'll just call it 6,000, which in my opinion, is arguably one of the most powerful levels in the market. Historically, and the graph doesn't show it, but if you go look up a chart, it's played out many times in the past. But due to the constraints of the slide, I've just got recent times. You can see it was resistance there. You can see it was support there. You can see it was support there. And you can see it was resistance there as well. Now, for those of you who have a bit more of an understanding around technical analysis, you'll also notice that a lot of the open and closes hang around 6,000 as well. So it's a major level. And we've got an example here of how its resistance here, the stock's gone up and come down. And it's also support here. It's gone down and come up, gone down and come up, right? And it's also resistance here, gone up and gone down. Now 6,000, is a key level, but you can see stocks go through these levels, right? It went through here, it went through here, went through here, went through here, went through there as well, went through back here and here as well. 6,000, support and resistance levels do break, right? But we can utilize that as well. When a support or resistance level breaks, it can be an indication that the stock is going to continue to move in the direction of that break. Again, adding another piece of the puzzle or another element to the canvas. So hopefully all of you are following me so far. I mean, this is stuff that you can basically get out of a book. I think it's fairly simple. What I'm trying to do is refine it for you a little bit, make you focus on the things that are important, all right? So when it comes to identifying support and resistance levels, look for ones that are key. If you don't, you'll never trade, I promise you that. So we're looking for things that have multiple touch points. And just remember that support and resistance levels can swap roles. The next part of the puzzle is trend lines. Now, trend lines are the backbone of technical analysis. The reason I didn't go through them first is because trend lines are basically support and resistance levels, but they just have a gradient or they just have a slope. So I needed you to understand what a support level was, what a resistance level was, before I could talk about trends. But in all honesty, trends are your backbone of technical analysis. Trends are so important that if the only thing that you did was trend analysis and you traded with the trend, you'd be better off than not, I would say, right? Trading with the trend increases your chances of success. There's an old saying, which is the trend is your friend. And I don't know who said that, but go to any webcast, read any book, and that line will be in there, I promise you. So what that means is basically if the trend is up, right, and the stock's traveling higher, then entering a bullish trade is more likely to be successful than entering a bearish trade, right, and vice versa. So as a new trader, especially if you're trading the medium term, well, if the trend is over a medium term period, if it's over a medium period of time, then it would make sense not to go against it, right? Because that's the period of time that the trend's playing out. If the trend of the stock in a long-term perspective or a medium-term perspective is up, and you want to do a short-term bearish trade, I still don't recommend it as a beginner, but you've got more chance, I would say, right? Because you're doing a short-term trade against a long-term trend, if that makes sense. But that's starting to get into kind of the nitty-gritty of it, and I feel like I'm getting a bit ahead of myself there. When it comes to drawing trend lines, you can often have more than one. It's a misconception to believe that there's only one trend. There's trends depending on the time frame that you're talking about. So what you want to do when you approach, especially when you approach a new stock, is start wide. Start on a really big view of the stock. Go out 2, 4, 6 years, whatever you want, right? Whatever makes sense. Some people come to me as beginners and they say, oh, on the 1 year chart. Well, why are you looking at a 1 year chart? It's just kind of a number, isn't it? Why not a 13-month chart? Or why not a 1.5-year chart or a 2-year chart? Why not an 8-month chart? Confining yourself to a particular time frame of a chart, in my opinion, is silly. What you're better off doing is starting out wide, looking at the graph, finding the low point or the high point, and then drawing your trends from there. If that happens to be a 3-year chart, so be it. If it happens to be a 5, 10-year chart, all right then. But start wide, draw your longer term trend, then edge in closer and closer and draw any other trends that are relevant, right? So you might have 5 trend lines, and only one of those or 2 of those trend lines might actually be relevant to your trading here and now, okay? There's also a difference between a trend and a trend line, right? It's something, again, that I would say a beginner makes a mistake of not noticing. A trend equals a stock that moves in one direction with successive peaks and troughs. A trend line is simply a line that we draw to try and connect at least 3 peaks or troughs, right? And I'm going to explain that a little bit more in the coming slides. So this is an uptrend, right? I know almost everyone here will understand this, right? I already know this. An uptrend is when a company's share price moves in an upward direction, right? Fairly obvious. It forms successive peaks and troughs, and I want you to understand that is what defines uptrend, is higher peaks and higher troughs. Until you see higher peaks and higher troughs, it's questionable as to whether or not it's an uptrend. A counter trend, as the name would describe, is a movement that is against the direction of the underlying trend. So a counter trend in this scenario would be any bearish trends that exist. See these downward slopes, right? Against the underlying uptrend. Now, when you draw uptrends, you always place the line underneath the bars. Again, if you've got experience, you'll argue that point with me, and you're right. Technically, you don't always put trend lines, uptrends underneath the bars, but for simplistic sake, as a beginner, always draw your trend lines underneath the bars. The idea is to try and connect the troughs to show buying support. So every time the stock comes down and hits the trend line, it bounces up, comes down, hits the trend line and bounces up. So it's a support level, it just has a gradient to it. It has a slope, an upward sloping, right? For a trend line to be valid or relevant, it has to connect 3 troughs, minimum. Minimum has to connect 3 troughs. 2 is not enough. And when you draw your trend lines, try not to go through too much price data, which are the bars on the chart. Now, you can go through some price data. You don't have to be super vigilant. You don't have to get out a magnifying glass. If you're an engineer, you don't have to get out your leveling tool and, get super precise here. As I mentioned, it's kind of an art as well as a science. But try not to go through too much price data if you can. Try not to go through the bars if you can, okay? So here's an old chart of Oz Minerals. And you can see I've drawn a trend line there. And it's a trend line because I've started at the lowest point. I've drawn it to roughly the highest point in some ways. And along the way, I've touched at least 3 touch points. In fact, I've touched 4 or 5 in this scenario. Right? So this is a valid trend line. And as I've drawn the line, I'm not going through too many bars. I snip off a little bit here, just a hair, right? And a little bit here as well. But that's okay. Right? It's not, again, you don't have to be crazy about it, but you try not to go through the price data if you can help it. Now, if I was going to draw counter trends on Oz Minerals, there's heaps of them. I've just highlighted a couple, right, as to not bore you. This is a downwards facing trend against the underlying uptrend, so it's a counter trend. And the same here as well, okay? Why you need to draw this stuff in will become more apparent later on. Now, downtrend's the opposite. It's obviously when a stock starts high and comes down low, and it starts to form lower peaks and troughs, lower peaks and troughs. And a counter trend is any upward movement against it, right? Any short-term upward movement. Now, a downtrend line as a beginner should always travel above the bars, right? So obviously an uptrend is underneath the bars. A downtrend has to be the opposite, right? You always draw your line on top of the bars. And the idea here is to instead try and connect the peaks to show selling resistance, right? So with an uptrend, we tried to connect the troughs to show buying power. With a downtrend, we're trying to connect the peaks on top of the bars in order to show selling power, right? And like an uptrend line, with a downtrend line, you have to have at least 3 peaks connected with the same line, right? It has to be a straight line, no squiggles, okay? Again, try not to draw lines through the price data, or in other words, the bars. So this is a chart of AGL, an old chart of AGL. Here is a picture-perfect trend. Again, starting at the highs, I've got 1 touch point, 2 touch point, 3 touch points, arguably 4 touch points there, right? Plenty of touch points. And we didn't go through too much price data. We just snipped off a little bit here, and that's okay, right? That's perfectly fine. Counter trends would be through here, through here, through here, right? And those levels are, because they go against the underlying trend, that makes them a counter trend, right? The underlying trend is down. Now, I guess, why do we do this? I mean, you can see that the stock is in a downtrend, Caro. Like, it's starting up there and it's traveling down here. Isn't that obvious? And you're right, it is. But by drawing a line that's linear, mind you, not a squiggle, that connects all the peaks, what it allows me to do is project into the future. So if the stock ever comes back to this downtrend line, then there's a good chance that it doesn't push through it and adds another piece to the puzzle that helps me speculate on the future direction of the stock, right? So this alone is not enough to trade on. Support and resistance isn't alone enough to trade on. But when you start combining all these things together, just like an artist applying artistic principles to a canvas, an image starts to be formed. All right. What we're going to move on next is to patterns, right? Now, patterns start to become clearer to us once we have our lines on the chart. So we've drawn our trend lines, we've drawn our support and resistance, our counter trends. Once we've done that, chart patterns start to become clear. Common types of chart patterns are triangles, channels, and reversal and continuation patterns. Now, reversal and continuation patterns technically often, I would say, don't even need lines to be on the chart to be seen. I don't want to go through those tonight. They're just extra learning. I'm only going to cover a few things. Now, like trend lines and support and resistance levels, there can actually be more than one pattern in play, believe it or not. And I'll show you. A type of triangle, there's three types of triangle patterns that are most common. You've got ascending triangles, descending triangles, and pennants. An ascending triangle is when you have an uptrend line meet a resistance level. And if you can just picture in your head a moment, the stock's traveling up and up and up, and it gets to a ceiling, and it can't get through that ceiling. But the march of time continues on, right? And the stock is being forced to the point of the uptrend line and forced and the resistance level, right? So that's literally a triangle there. Eventually, one of them is going to break. And the idea is that once one of them breaks, it continues in that direction for a number of days. More often than not, the trend wins. A descending triangle is the exact opposite. It's a downtrend line. So if, again, in your mind, close your eyes if you can picture it, a downtrend line, stock's traveling down and down and down, but it gets to this floor and it just can't push through that floor. It's bounced off it several times, right? So you've got the downtrend line, you've got the floor, and the stock keeps pinging in between the two, but eventually one of them will break. Either the downtrend line will break or the floor will break, also known as the support level. And whichever one breaks, the stock theoretically should continue in that direction for a number of days, right? More often than not, the underlying trend wins. Finally, a pennant pattern is when an uptrend line and a counter trend line converge. And we just basically looked at a chart of that. So here's an example of an ascending triangle. Hopefully this is what your mind's eye was projecting. You can see the stock's traveling up and up. And this is Oz Minerals, mind you. This is today. I took this screenshot today. You can see it's traveling up and up, right? It's a nice solid trend line there, plenty of touch points. And then you have this resistance level. We'll call it $15, $14.98. My gosh, we'll just call it 15, right? It failed to get through here, it failed to get through here, failed to get through here, and it failed to get through there. So on at least 4 occasions, Oz Minerals has failed to get through $15 in any convincing manner, right? But at the same time, Oz Minerals also wants to keep traveling higher. So eventually, these two lines will converge to form a triangle pattern, and the stock will be forced to the point of it. Eventually, one of them has to lose, right? The trend line either has to lose or the resistance level has to lose. More often than not, though, it's the resistance that loses. the trend line usually wins. All right. Again, another good reason as to why you should trade in the direction of the underlying trend. This is the same chart that I showed you on AGL, right? Here's a pennant pattern. You've got the underlying downtrend, and now you've got the counter trends. But look who wins. So you've got the downtrend line. Here's the counter trend. That's a triangle pattern, isn't it? If we just isolate that, that's a triangle. The downtrend won, didn't it? You could even draw another one up through here, downtrend one. Draw another one up through here, downtrend one. Draw another one up through here, and look, the downtrend won again. One could even maybe draw another counter trend up through here in which the downtrend is 0 for 5. You know, it's a 5 for 0, I should say. Undefeated champion, the downtrend line in this scenario. Eventually trends break. Eventually you're wrong, right? But the idea is to make money up until that point. All right. So a pennant pattern, a very common, frequently occurring pattern. The other type of patterns that I want to run through tonight are channel patterns. Also, I would say very easy to understand. There's 3 types of channel patterns that I'm aware of, at least. Flat, descending, and ascending channel patterns. And they're, as the names describe to you, that's exactly what they are. An ascending channel is when the stock is trading against 2 parallel lines that are rising. So you've got the uptrend line through here, very short-term uptrend line. You can see this is since the start of September, quite literally. And then what I've done is I've literally duplicated the line and put it on top, right? So this is where I was saying before, trend lines technically, uptrend lines technically don't need to be underneath the bars. You can draw them on top, but usually we only do that when they're in conjunction with a trend line that also exists underneath the price data. So here's an example, right? You've got the uptrend line, 3 touch points, 1, 2, 3, and you've got the exact same line with the same gradient just on top of the stock. And that defines a trading range. It goes up there, comes down here, goes up there, comes down here, goes up there, and comes down here. It's not perfect, but it does help you identify perhaps where the stock is going. If it does rally up, $15 is a resistance level, but perhaps it might get to, I don't know, $15.50, where that line comes in before it turns around. A flat channel is what we looked at earlier. This is the XJO. This is the ASX 200. This is the chart that I used earlier to describe to you resistance up here, remember, and support down here. Now, when you have a very strong level of resistance and a very strong level of support, which the stock is continuously trading in, that's obviously just your typical channel pattern, isn't it? Or a flat channel. I didn't know what to call it. I'm just going to call it a channel, right? The stock likes to bounce like a you know, what's that game called where you got the flippers and the little metal ball at the arcade? Anyway, I can't think of it right now. Pinball. It's like a pinball. It bounces up and down between the two, between the key level of resistance and the key level of support, right? And again, like it helps you identify potentially where the stock's going, doesn't it? When the stock gets up here these times, it's fair to expect a sell-off. Just like how the stock reaches at these support levels, it's fair to expect a rally, right? Again, not the only piece of analysis you need to be doing, but another piece of the puzzle, another artistic principle applied to the canvas to help define what the picture is and where the stock is going. You can also have multiple patterns in play, and I did mention this earlier, and it can be a little bit confusing. Sometimes with technical analysis, if you overdo it, you get what you call analysis paralysis, where you don't end up doing anything because you've just got all this conflicting information. It's why I said to you earlier, don't draw in every resistance and support level, because you'll pull your hair out and you'll never trade. Instead, look for those key levels. Patterns that you can anyone guess what type of patterns very simply, what type of patterns we're seeing in play right now? I'll give you a moment to think about it. Well, I would say that you've got the channel, right? You already got given that one earlier. And I would also say that you've got somewhat of a descending triangle in play. You've got the downtrend line here, and you've got the support level there. You could also draw in a support level high at roughly 5,800 if you wanted to. That's perfectly valid, right? But again, I am trying to keep tonight simple. So you've got two patterns in play. You've got the descending triangle and you've got the channel. And the question is, all right, Caro, hang on a second, which one do I listen to then? Which one should I trade? Richard's actually brought up a good point. There also was a pennant through here if you draw the uptrend line through there, right? The counter trend. There was a pennant pattern in play as well, just to make it even more confusing for you. If you come along and do our course, if you study technical analysis, if you talk to us, if you practice, you'll be able to answer this question. And it's not too difficult. But there can be multiple patterns on a page. One of the final pieces of the puzzle are technical indicators. Now, technical indicators are mathematical algorithms presented as a graph, or often presented as a graph, right? So when we look at a chart, all those bars, all those bars are is just prices that the stock's traded at. You can represent that data as numbers on a spreadsheet if you wanted to. It'd be stupid, but you could. And mathematical indicators or technical indicators are the same thing. You can represent them as numbers on a spreadsheet if you want and go insane. Or you can represent them as a graph, right? And quite often we do. Technical indicators are confirmation tools only. Another rookie mistake, another beginner mistake is to put way too much emphasis on technical indicators. Because they're kind of fancy and they look kind of cool and you feel like you're kind of cheating a little bit by using them, you start to, as a beginner, you start to feel, oh, well, hang on, why would I draw my trends, counter trends? Why would I bother with support and resistance level? These technical indicators are the bomb. They're going to tell me which way the stock's going. And at first, it can kind of feel like that, but I can tell you right now, that's not the reality. Technical indicators should only be used as a confirmation tool. And the reason why I'm talking about them last is because that's the process that you should be doing things in. Covering your trends, support and resistance levels, counter trends, looking at technical patterns, and then only at the very end do you look at technical indicators to confirm your view, okay? Common indicators are things like Bollinger Bands, stochastic oscillators, moving averages, RSI, MACD, right? Those are the ones that I thought of off the top of my head. They're the ones that I've used in the past and use to this day. There's other ones that people use. You can type them into the comment section. There's heaps of them, right? I'm not going to go through everyone because I just don't have that sort of time. In fact, it's 7:45. I'm running out of time. I do want to run through stochastic oscillators though, right? Because I had a question from I had some feedback from the last webinar where someone that we spoke to mentioned that they wanted to run through the stochastic. So I thought that was, a good opportunity to run through one type of indicator that we like to use as technical analysts. Stochastic oscillators on the whole indicate momentum. They have an oversold and overbought area, so they'll kind of tell you if the stock's looking oversold or overbought in that time frame that you've selected. They can indicate a change in direction, and they can indicate divergence. Fibonacci, Buani is, if that's how you say your name, I apologize if it's not. Yeah, Fibonacci is one that I've used. I do use. People I find lean on Fibonacci a lot or not a lot at all. It's kind of polarizing, I find. But yeah, I use Fibonacci every now and then, especially if a stock has had a mad run and then it's correcting. I love to use Fibonacci then, Fibonacci retracements. That being said, if you're really good at placing your support levels and your resistance levels, you'll find that they coincide with your Fibonacci numbers anyway. So you're kind of doubling up on work there, but there's nothing wrong with it. Absolutely. But getting back to the stochastic oscillators, you can see this is the chart that has all the weird stuff on it, right? So it's not just the bar chart anymore. You've got these orange lines, they're the Bollinger Bands. Got this blue line here, that's the 100-day moving average. Got the green line there, which is the 50-day moving average. I've also got a 200-day moving average that's not on the screen. That's volume. And this little bad boy down here, that's the stochastic oscillator, right? And you can kind of just see, like, if you've just never been told about them, if you're kind of intuitive, you can just kind of see that it looks like the graph, doesn't it, right? The way this is moving kind of looks the way this has been moving. And this is a chart of ANZ, mind you, today's chart of ANZ, right? Now, the stochastics have an overbought area up here and an oversold area. Now, you can adjust these parameters however you want. We've got specific parameters that we like to share with our clients, right, that we find very useful. But you go to a different education house, you go to different traders, you'll find that there's a whole bunch of different parameters that you can set these indicators at. But here are the overbought and oversold area. And one thing I want to draw your attention to is that, for example, when the stock has dipped heavily into the oversold area and crossed over, can you see how the red and blue lines have crossed over? Kind of coincides roughly with these days here, doesn't it? And the stock's gone from an oversold area, right? So it's falling, gets to a point it's oversold, crosses over, indicating a change in direction, and then starts heading up, right? And the stock starts heading up. So if you're on these days here, you would, combined with your other analysis, as a caveat, combined with your other analysis, would feel confident that ANZ was going to rally for a period of time. You can see the same thing happened down here. It got heavily into the oversold area, more so than this period here. Heavily into the oversold area. But roughly around these days here, it started to cross over, indicating a change in direction, right? And the stochastics were pointing up. The stock and all the other analysis, you could argue, was giving you bullish signals, and it started to travel higher. So again, you can see how they're pretty nifty, right? Like they're a really cool tool, but you can't, I can promise you right now, it is not something you want to base your entire analysis on. They're a confirmation tool, okay? Now, divergence was something that was, like I said, I just wanted to mention. I don't want to go through it tonight too heavily because I would say it's fairly easy to teach, but it takes a while, I would say, to kind of understand it. In short, you're looking for different trends, right? You want to see a divergence, as the name implies, between the bars or the chart and the stochastics. You can see there's some kind of really slow moving uptrend on Flight Center, right? This is Flight Center's today's chart of Flight Center. Very slow moving uptrend. You can see there's also a slow moving downtrend on the stochastics. That's divergence. It's when the stock separates or diverges from the stochastics, and that can help you indicate which way the stock's going to go at some point. Stochastics are awesome for divergence. In fact, I would say that's probably the greatest aspect about stochastics, but I don't teach divergence to beginners because we've been going for 50 minutes right now, and I've barely, scratched the tip of the iceberg, as they say. Divergence is something that I will, as your trainer, kind of teach to you as you get a bit more experience. So I don't really want to go too heavily into it tonight. The idea here is that when you see divergence, it helps predict a change in direction at some point, okay? Now, what we're going to do is just quickly bring it all together, and I want to bring on Tim, right? You can see we're creating higher peaks and higher troughs in this scenario. Remember, an uptrend is defined by higher peaks and higher troughs, higher consecutive peaks and higher consecutive troughs. A trend line, on the other hand, tries to connect those troughs. And we always try to connect a minimum of 3 troughs. If you don't get 3 troughs, it's not a real uptrend line. It's a tentative line, as we call it, okay? You could also duplicate that exact same line and place it on top, and it gives you a market range or a trading range, right? Now, what type of pattern is this? What type of pattern is this? Just off the bat, we've got our uptrend line and we've duplicated to sit on top. It's a channel, isn't it? But it's just an ascending channel. So it's a channel, but it's rising. Next, we draw in our support level. Right, very clear level of support. You can see it touched here recently, locally, touched there, touched throughout this period. And it was also resistance throughout this period as well. Another example of how support and resistance can swap roles. Next, we draw in our resistance level, and you can see that it was resistance through here. It's not perfect, I understand. And it was resistance through here as well. Now, one thing I didn't create any slides for because I didn't feel like I needed to, but what I'm going to cover now is your entry signals. A lot of everything that I've covered so far will help provide entry signals for you, right? But depending on how aggressive or conservative you want to be, or how tight or loose you want to be with your trading rules, depends how much you listen to this part. We teach our clients that you do want to look for a very specific type of entry point. I'm going to share that with you tonight. So this is today's bar, right? Today's bar has the open, high, low, and close. We good with that? When we look for an entry signal, we want for a bullish trade, we want to see the current share price in the opposite third to the open. So if you can just visually with your eyes right now, obviously the vertical bar here is the day's trading range. If you can split that into thirds like you're cutting a cake, you want the close to be in the top third for a bullish day, and you want the open to be in the bottom third, right? So they're in opposite thirds of the day's trading range. You also want to see buying power be there for at least a day, right? Or no more than 2 days. So what we're looking for is a higher high and a higher low. So we want today's high to be higher than the previous day, and we want today's low to be higher than the previous low. What this essentially signals to us is that there's buying power coming into this stock, and that we're not jumping in too early without confirmation. And by limiting ourselves to the second day of the move, we're not jumping too late into it either. If that kind of flew over your head a little bit, that's okay. It's not complicated. It's just a little bit wordy, right? I've never really found a great way of explaining it, to be honest with you. But if you did understand it, then that's great. Finally, once we've done our trends, counter trends, found patterns, support and resistance levels, right? Once we've done all that, only at the very end do we look at our mathematical indicators and confirm our view. So we're looking at the stochastics, and you can see the stochastics have gone into the oversold area down here. So the stock, according to the stochastics in the short term, are oversold, is oversold. And you can see it's crossing, and the cross indicates a change in direction. So it's been falling, it's crossed, indicating a change in direction. The change of direction would be therefore bullish. The stochastics, both of them are slightly pointing up, which is positive, and they're starting to come out of the oversold area. So this confirms our bullish view. This is a trade that we would likely see, talk about, and then put to our clients. So Tim and I and the other advisors, a couple of other advisors on the trading desk, we would meet at 2 o'clock like we always do every day, Monday to Friday. We would bring up this chart and we would say, what do you guys think of this trade? Fits all the trading rules. And then I would type up the words. We would get a chart together. We'd get the trade together, the strategy, where we're going to enter, where we're going to exit, where we're going to take profit, where we're going to stop loss out, how many suggested minimum contracts we're going to do. We would bring all this stuff together, right? And we would email it to our clients. And the reason we would do that is because we have our trading rules. Our trading rules make our life easier. It takes the guesswork out, doesn't it? Rather than making trades based on emotional decisions, we've got a set of step-by-step rules that allow us to analyze stock and then take the emotion out of it, essentially. And I suggest that all of you who are beginners find a set of trading rules that works for you. If you come along and do our education, we'll give you the trading rules that we use. Okay? All right. I am going to hand over to Tim. I have gone way over time. I covered a lot of ground. I hope you guys enjoyed it. I really enjoyed teaching it. I'm sure you can tell. Again, we're just scratching the tip of the iceberg here. There's a lot more that we like to cover, and we don't try to teach it to you all at once, right? If you come along and do our workshop, there's a face-to-face component, which is done by Stream right now. But then what we do is we work with you over the coming months. You could use me as your trainer if you wanted to, and we would slowly develop your skills over time. So if you felt a little bit overwhelmed tonight, that's okay, but hopefully you feel like you understand what it is that you've actually got to go out there and learn, okay? Let me just pass it over to Tim. One moment.
Okay, perfect. Thank you very much, Cara. You just did a fantastic job of giving you some foundations around technical analysis. Okay. Give me a second. I'll just start my screen up. Perfect. And then I just want to cap things off a little bit here for you guys, and just sort of bring some of this together and show you how we can use technical analysis to help us to predict the future direction of the market. The better you get at technical analysis, and I say better you get doesn't necessarily mean knowing more. Better you get is more so just having a simplistic set of technical rules that you follow. There's so much. The technical world is massive, guys. It's huge what you can use out there. And somebody asked before about Fibonacci. Fibonacci, that's just another type of technical analysis you can learn, right? There's just so much of it, guys. So what we do for our clients and what we do through our courses is simplify it, okay? So we utilize some of the techniques that Cara has shown you tonight. We put that together in a set of rules that gives you a heightened probability of picking the market. Okay, it's not going to give you, it's not the golden egg, guys. It's not going to give you every single trade right. That's impossible. And throughout times where the market's extremely volatile, and we had a period of time a couple of years ago where every time Trump tweeted, the market would, next morning forget technicals, the market would just move on what Trump tweeted the day before, right? So sometimes the market moves against us, okay, and that's because something's happened overnight or something shocked the market and everybody's all of a sudden changed their view, right? That happens, right? So it doesn't matter whose system you use, it doesn't matter whose rules you use, it doesn't matter, you're not going to get every trade right. And that's where there's an importance on what strategy you use to trade the market and the importance on risk management, right? So these are the three pillars. These are the three things you must learn to be good at trading. Is picking direction, which we're covering tonight, talking about technical analysis in a lot of detail. But next week, we're going to start talking a lot more about what strategies you can use to also give you an increased probability of success, and also how to start thinking about risk management to ensure, one, you don't have all your eggs in one basket, just in case things do go wrong. And two, to make sure you've got your entry and exit points really planned out properly. Okay, know when you're getting out of a trade before you get in. I say that, I can say that a million times. I say it for my own sake. I say that for my clients' sake. Always know when you're going to get out before you're going to get in a trade. All right, it's very, very important. So, look, tonight, like I said, we're talking a bit about picking direction. And that's what makes up our trading rules. Now, sort of bring some of that information in and show you through some of the trades we've been doing recently, and some of the reasons why we've entered those trades. And I think this will give you a bit of a picture, not only about the importance of technical analysis, okay, the importance of the three pillars that I just went through then, but also gives you a bit of an insight on what we do on a daily basis. As Cara said earlier, part of our daily job is to put trade ideas out to clients in form of recommendations. So these are some of the recommendations we've been doing recently. Okay, so I'll start off with Wally Parsons. Okay, or Wally Limited. They've changed their name to recently. So Wally is a bullish trade that we entered back on the 26th of August. We're still in this trade at the moment, okay? So what I want to first do is just talk to the reasoning why we're in this trade. So I'll just jump across to the chart now, okay? Now, Wally Parsons, let's go back to the day we got in, which is back here, okay? That's the day we got in there. And let's have a look at the technical view at that point of time, all right? Wally had already fallen off quite aggressively through here, following the rest of the market down through that COVID pullback, okay? From there, so it was downtrending for that period of time, extremely steep downtrend, very aggressive downtrend. Once that downtrend finished, it started a new uptrend, right? The definition of an uptrend is higher peaks and higher troughs. Cara showed you that in a slide earlier, okay? So we've got the uptrend through there. That trend then changed to maybe down to quite a bit sideways, wasn't it, right? So we had a little bit of lower peak, lower trough. Then all the peaks and troughs through here were really fairly well equal, okay? So we went from an uptrending move into a sideways phase. We had a little bit of a breakdown through here, held some previous support, but started bouncing up. And when it started bouncing up here, guess what? It started forming a brand new uptrend, hasn't it? Okay, so a nice brand new uptrend. The stock had just reported, quite a nice report as well, which also helped, okay? And it's, yeah, so it fit all our technical rules, didn't it? So we had an uptrend in play. We broke out of a sideways pattern, so we broke the channel, okay? And remember what Caro told you about breakouts, all right? So we had the breakout to the upside. So we got into a bullish trade there. Now, let's bring my slides back up. Okay, so to explain the trade a little bit, the share price at the time when we got in was $9.69. Okay, so I've just shown you the technical reasons, okay, why we've gotten into the trade. The picking direction element of our rules, okay, is covered. We've fit all the rules for a bullish trade. So now we have to pick a strategy. Now, I'm not going to talk about strategy too deeply tonight, okay? That's what we're going to cover next week, okay? So jump on next week. But this strategy we've chosen is called a mini long, and we'll explain this next week. And the price of the strategy to get in is $4.06, okay? So the share price, if you're going to buy the stock outright, it's $9.69 if you wanted to trade using the stock. But we're using a special derivative product, okay, that allows us to get in at a cheaper price. Now, our risk management is the next important thing, okay? We don't get in without a strategy. We don't get in without risk management thought out on that strategy. So the amount of dollar risk we decide to put on the trade is 3,400, okay? I'm not going to explain how we got to that number yet. I'll explain that next week as well. But what I want to talk about is the stops that we're using, okay, and the importance of those stops. So we've suggested a stop loss at $9 and a profit target of $11. So we'll be looking to take profit, and we want to make sure we can make enough profit at 11 to warrant the risk on the trade. Now, why have we picked those levels, right? Once again, it comes back to technicals, okay? So $9 is just through here. Now, what's my technical view if if the share price goes back below $9 here? What it means is where that upward breakout has failed. We've broken back into the channel. By then, this trend line would have also broken, and the stock's going to be looking a little bit more bearish. Now, as a short-term trader, and any trade we do get into, really, would love to be in and out within a day, if not a week, if not a month, if not, okay, well, if we have to wait 3 months, so be it, right? As long as the strategy allows me to do that. But we always want to be out short term. Now, what we've got to do is keep reconfirming what our view is, right, as we're in the trade. But as long as if $9 breaks, can't think about it too much, I've got to close, right? That's the rule when we set this strategy up. So if you have a look at what this stock's done, it started trending up, which is fantastic. Doing quite well so far. Trending up. So we're way away from our $9 move, okay? And now what's happening is it's starting to go sideways again, isn't it? All right, so it broke our trend line through here, but it's now establishing a new channel, okay? Going sideways, and we're still waiting, okay? So what's happened here, guys, is, the momentum's still up, the trend's still up. It keeps changing the angle of that trend, isn't it, right? So that's a fairly steep trend. It's still uptrending because we've got higher peaks and higher troughs. And even now, even though I want to draw that line, even though it's broken the trend line through here, it's still an uptrending stock because I've got higher peaks and higher troughs just in the short term stuck in the channel. So we're still happy to sit on this trade and wait because time's not a problem for us. And, we're in a profit. So we're okay with that. And, eventually we think this upward momentum, although quite slow, and we might be still sitting for another 2 or 3 weeks, we're happy to sit on the trade because it hasn't fallen below my stop, which is $9. And the trend is still technically up to sideways, okay? So yeah, look, that's just an example of one of our trades that we've got out there. I can show you here. This is what we send out to clients. Okay, so we tell them, you know, that's the date we got in. We suggest an entry price with a bit of discretion. Suggested minimum contracts, which is the minimum risk there. We use minimums, guys, because we think about, okay, well, how much is going to be made if we hit our target, which in this case was around. Well, it wasn't actually 11, it was 1085 if I'm going to be exact, but 11 is pretty damn close, right? So the reason why we've used 11 as a profit target is it's the previous resistance back here. So we're always using these levels, whether it be support, resistance, or the trend lines, or various different technical reasons to also manage the risk of our trade. Okay, because we've got to make sure there's enough money in it for us after brokerage and all the rest of it when it hits the resistance. And we've got to make sure we don't lose too much if it proves us wrong. And in this case, we've decided that level of proving us wrong is $9. Okay. Now, in this case, if it broke through $9 and we got out quickly, we'll probably only lose about 20%. And what I want to say here is we've chosen to risk 3,400 on this trade, and we're comfortable losing 20% of that 3,400. Now, if your trading bank is only 3,400, you shouldn't be putting 3,400 on this trade. What you should be doing is dividing your bank up over various strategies and various trades. Okay, so for instance, in my trading account right now, I have 4 different trades on, and I still have 40% of my cash sitting in my bank account as ready to trade something else, or as a bit of a backup. So there's a few things to think about here, and there's a few concepts I've just covered, right? We've got picking direction, which is important to give us a probability of success. We've got strategy, which we'll show you next week, can be used to increase your probability of success. And then risk management, which is there to protect you when things go wrong. So I've heard too many dreadful stories of beginners that have gone out there to try to do this on their own. They haven't listened to any professionals. They haven't listened to or read enough books. They haven't, spent the time to get the skill. They've just gone in and dabbled. And what a lot of people do, unfortunately, is put their whole bank on one little small cap or micro cap stock that their mate told them to put the money on, and they've likely bought very close to the highs, right? And then things get disastrous. Don't do that, guys, right? There's many different ways of trading the market, but these 3 pillars that we're talking about here must be obeyed. It doesn't matter what your style of trading is, whether you're trading stock, whether you're trading small cap, whether you're trading micro cap, whether you're trading options, whether you're trading mini warrants, whatever you're trading, you've got to have a set of guidelines or rules to tell you, all right, the market's likely to go up or down or sideways. What's the pattern? Let's get some probability of picking the direction, right? Then you need a strategy, whether it be buying the stock, buying derivatives, using derivative strategies, which we'll teach you next week, and then risk management, right? And I'm repeating myself here, guys. I know I'm repeating myself, and I'm doing it on purpose. I'm trying to brainwash you, okay? Because you've got to hammer this into your minds. As new traders, you don't get into a trade unless you've got the probability of picking the direction, right? A strategy in play and risk management, okay? All right, so the next trade I'm going to show you was a very quick trade, okay? We're in and out of this overnight, in fact. So AGL bearish, we actually got into this a few days ago, right? Now let's look at the reasons why we got into this trade. What's the trend? It's down. We've got lower peaks, lower troughs, lower peaks, lower troughs. We've come back up and tested the current downtrend line, and we've now thrown up another bearish signal. So we've decided to get in on this trade. Now the strategy this time, okay, we got in at 14.08. The strategy this time was a straight put option, okay, a bought put option. Now I'm not going to explain what that is, right? We'll talk about options next week, so jump on. But the price of this trade was 77 cents. The risk on this trade that we suggested, the minimum risk, was just under $2,000. Now, the suggested stop was 14.50. and that's our stop loss level. And our profit target was 13.75. So one thing you're going to see straight off the bat, okay, is we're making money. We're going to make profit from this trade from a downward movement, not an upward movement. And that's something you can do with derivatives, okay? People do short sell stock, and that means being able to profit from downward movement, but it's out of reach for retail clients like ourselves and yourself, unless you use a derivative product, okay? And we'll show you that next week, okay? So you can trade the downward movement. And the great thing about trading the downward movement, guys, is it opens up your ability to find more trades. You don't have to be waiting for a market to go up and up and up. There's always stocks in the market that are going up. There's always stocks in the market going down. What you're looking for is a nice, clear technical trend or pattern playing out. And if you find those trends and patterns, all right, like what Caro's shown you tonight, channels, ascending triangles, descending triangles, all these patterns that we'll teach you through our courses, okay? Too much to teach in an hour session at night, guys. So it's just not going to happen. As you see, we're covering a lot of ground and the time runs very quickly, right? So what we've got here, and the reason why we've picked 1450 and 1375, let's go back to the chart and have a look. Oh, hang on. I had the chart on my slides, didn't I? I'm so used to jumping back on the software. Sorry, give me a second. I'll go back up here. In fact, I know where I put it here. These are the reasons why we picked those levels. The most recent resistance was around 1450. If it breaks 1450, guess what? We were going to have a higher peak on our hands, aren't we? And we're going to be proven wrong. We're going to be breaking in the wrong direction. So we want to get out of there ASAP, right? We don't want to be mucking around. So if it breaks through 1450, we're out of there as quick as possible. And then the reason why we've used the 1375 as a target is because if it reaches that target, a profit target, we've got to make sure we test the strategy we're doing to make sure we're making enough profit out of it. There's no point getting into the market and not making enough profit to warrant the risk. It's always risk and reward, right? So you're going to balance that out and go, okay, well, if I can make 30% down there, but I only lose 20% if it breaks out, guess what? If I keep repeating that and get more right than wrong, I make a profit, yeah? And that's how you make money out of trading. So there's a few little tests that we're doing here. There's no point in getting out at 1450 if we lose 50% of our money, but only make 20% profits on our profitable side. There's no point in doing that, right? So this is where the strategy and risk management side of it is really, really important. And that's what we're going to show you next week, once again, all right? Okay, so AGL, we managed to close out for a profit, all right? So did I put the... No, I didn't. Okay, give me a second. Coming back to the chart over here. So basically, the next day it dropped down. And guess what? It went straight through support, okay? Went straight through support. But we closed out anyway, right? Because at this point, it was a reasonable enough profit. And with the market being so whippy of late, it being very sideways market for the last few months, happy to take profits quickly, right? Just happy to do that. So let's have a quick look at what we made. Okay, we got out with the share price falling 2%, okay, to 13.80. The derivative, the price on exit for the derivative was $1.04, which means we made 27 cents on the trade per unit. I haven't taught you any of that yet, so don't worry. But we made $675 off our 2 gram risk, which was 35%. Now, this is just a demonstration on what leverage does, what derivatives can do, is that we had a 2% fall in share price, but we made 35% on our strategy, okay? So derivatives are a great thing to learn, guys, but understand that leverage, you know, with the rewards that you get like this also comes risk, okay? Because if it went up past our stop loss, we would have probably lost a very similar amount, okay? So, you know, use derivatives wisely. It's very, very important to have strict, once again, risk management rules when using this type of product, okay? Otherwise, if you go at it blind, honestly, it's going to be disastrous, right? You've got to have a set of rules here. Very, very important. All right, last one I'm going to go through, and this is a trade we're still in at the moment, okay, is a Newcrest mining trade, okay? It's a gold miner, and we know how popular gold's been of recent, right? But gold has pulled back and it has been going sideways for a while, right? So we've decided to do a strategy which allows us to profit from sideways movement, right? Bullish to sideways movement. We don't want it to fall too much. The fantastic thing about this particular strategy, okay, is that we can look for a key level of support on a stock. And if we believe that key level of support is going to hold, we can base our entire strategy around that level. See how, once again, technical analysis is coming into play in the decision making here. So once again, back to those three pillars. Technical analysis, which is picking the likely direction of the stock. In this case here, 3086, you can see how many times that level has been tested. Now the stock's uptrend has stopped. We've had a pullback, so the short-term trend is down, but now we're back at that level of support, and our technicals are showing a break back up to the upside. I should have a resistance level through at 32 here to show that breakout. But there's a breakout back to the upside, which is saying to us there's buyers at this level. People are interested again. It's had a nice little bit of a pullback. It's looking very oversold in the stochastics, and the buyers are back. Okay, the buyers are back at key support. But gold's going sideways. The market's going sideways a lot at the moment. So we want to make sure we're protected. We're choosing a strategy that's going to increase our probability of success in the current market environment. And that's why we're deciding to do a bullish to sideways strategy. So we got in on the 14th of August. Sorry, August, I was thinking the wall is passing straight. 14th of September, right? So we've already been in this for a few weeks. The share price at the time was 32.36. The strategy we have chosen is a bull put spread. Okay, so this is an option strategy called a bull put spread. The price on entry was 12.5 cents, and that's actually receiving a credit. Don't even try and get your head around that. We'll talk about that next week. But yep, so that's the price on entry. The risk on the trade was 3,750. And the suggested stop loss was 30.50, okay, which is the support level. I'll show you that in a moment. And the suggested profit target, right? So the profit target is if the stock is above 30.50 on expiry date. And that's what makes this strategy unique. See, with this strategy, as long as the stock stays above 30.50, by the way, the share price is at 32.36, as long as it stays above 30.50, on the expiry day of the derivative we're using, okay, we're going to make a profit, right? And the profit's about $1,200, okay? So we don't need upward movement. We can have some downward movement. I don't mind that. As long as it stays above 30.50, we're happy, right? Okay, so let's come back to the chart of Newcrest and show you where we're at now, all right? Zoom out. And once again, this is where the probability comes in. Have a look at that support level. Back here in 2019, July, through here is resistance, through here is resistance, used it and played around with it here, and now we're using it as support, okay? Now, what's happened is the stock's come up, it's come back down, it broke that level just a little bit one day, reversed, come back up. And the reason why we didn't get out of the trade that day, by the way, is there's still one little level that it had to get through there, right? But also we saw a little bit of buying in the gold space that day, right? So we looked at the underlying sort of commodity that these guys mine, so some fundamental reasons. But also there's a little bit of a reversal coming in, okay? So there's a few reasons why we held it that day. But nonetheless, guess what it's doing? It's holding above. Oh, sorry, I've got the wrong level in. It's 30.50. It held our level, right? Sorry, my bit of a senior moment there. 30.50 was down here, guys. Sorry, I had it drawn in at 30.87. Right. So the reason why we stayed in is we're following our rules, right? But nonetheless, guys, have a look at the power of this strategy. We've identified a key level of support in this market, right, around this level. And as Caro said, you know, it's not a perfect science. You can call that the level around here. Always have slippage, guys, right? You're drawing your levels with a texture or pen, right? That's the big thing. The thicker you make it, well, you know, let's do this for a second, okay? It's thereabouts, right? You can't be exact with these things. It's not an exact science. And this is why I don't like algorithmic trading. I still would like, I still to this day, even though I could go build what I do into an algo, there's still some finessing here. You've got to allow for slippage, right? You've got to allow that the stock might sneak a couple of cents through your stock and then come straight back up again, okay? But nonetheless, guys, there's a key level around this 30-50, and that's what we base this whole trade on, okay? So once again, it all comes back to the three pillars, right? In every decision we make, comes back to these three pillars, right? Picking direction using technical analysis. We're trying to predict where the stock's going to go next, whether it be up, down, sideways, whether it's going to go up aggressively, whether it's going to go down aggressively. You know, technical analysis gives us hints to all of that. Then it's all about strategy, okay? So as I've shown you, 3 different strategies just there, okay? A bullish mini warrant, a bearish trade using options, and a sideways to bullish strategy, the strategy where we just need to stay above support, also using options, okay? Then risk management, where there's 2 elements of risk management, is how much of your bank you put on one trade. You want to have more than one trade in the market, so you've got to do some maths there, right? Divide your bank up to various strategies, okay? Then also, where are you expecting to take profit? And where are you thinking about taking your loss? And are you happy with those odds? Are you happy that, okay, if it hits through that stop, I'm going to lose X amount. If it hits this target, I'm going to make X amount. I think this is a good proposition, right? And that's what these 3 pillars are, okay? And that's what we basically teach people through our courses, okay? You know, I can't sort of say how important it is, right? It really is, you know, it's critical, right? Otherwise, you know, do you want to be a long time in the market? Do you want to be trading 5 years from now? Or do you want to be in there for a couple of months, say this doesn't work and move on, right? That's the difference here, right? Using this compared to using nothing, you're not going to be in the market for long, guys. You really aren't. You'll have some success, but I can tell you in the medium run, you're going to get decimated, right? You've got to have these 3 pillars working for you. All right. I'm just keeping in mind the time, so I'm going to wrap things up here. Okay, just something I want to leave you with. Okay, if I can pass you a little bit of knowledge here. Okay, the concept of knowledge refers to familiarity with information and theoretical concepts. Knowledge can be transferred from one person to another, or it can be self-acquired through observation and study. Skills, however, refer to the ability to apply the knowledge to the situation. So let's have a look at this. Knowledge, you get that by reading books, okay? You'll be reading various articles. There's plenty of free and paid content out there. But there's one thing to have knowledge, guys, right? And you can go and read a million books on the market. And knowledge is great, but it's useless if you don't know how to apply it. So what you've got to be doing, guys, is yes, one of the first steps in becoming a trader is gaining some knowledge, right? And learning a bit about technical analysis, learning some different strategies. But without the full picture of the skill and learning that skill, you're still a step behind, right? You've got to apply that skill and apply it over a period of time. So skill, how do you get skill, right? Well, you've either got to do a practical course, right? So, you know, there's 2 different types of courses you can do out there. There's more of a knowledge-based university type course, or you could be looking at more your TAFE style course where it's more practical, where they'll teach you some knowledge, but also get you hands-on, okay? So you need to get hands-on, right? You've got to build your skills. And the only way you can build skills is by doing a practical course, learning from other people, doing it yourself, okay, learning from your mistakes, and discipline. Because you need the discipline to keep going at it until you learn the skill, right? You know, bring it back to when I was young and I was first learning how to use a hammer, right? I can't, like, how many times did I hit my thumb, right? Heaps of times. If I gave up, I would have never learned how to use a hammer. And this is a really basic analogy to be using here. But now I've used a hammer so many times in my life that I rarely hit my thumb, right? I never really hit my thumb using a hammer now, okay? So I know when to be careful. I know how to aim my hand. It's the same thing with trading, guys. Honestly, you can learn all the knowledge you want. You can listen to us on these webcasts all you want. But until you sit with somebody and learn those skills and go apply those skills, you're not going to get great at trading. And this is where I always say to people, learning to trade is like starting a business, okay? The first year could be a complete write-off, okay? We could teach, and this is the funny thing, we teach everybody that comes through our courses the same set of rules. Some people are successful and some people are not. And why is that? Why are some people successful and some people aren't? One thing is discipline, but the big thing is attitude. You've got to stay positive, guys. You've got to stay realistic and you can't give up, right? These are the three things that you've got to think about. Gain some knowledge about the markets. You've got to learn about the markets. You've got to understand how the markets work, right? And we scratched on a bit of that last week. We've taught you some more knowledge around the market this week. But then you've got to start turning that knowledge into skills. Okay, you've got to be able to understand and know how to physically get out there and go, all right, I should be hitting the buy button now. I should be hitting the sell button now, right? And these are the reasons why I'm doing that. I'm going to be disciplined enough to stick to those reasons, okay? It's so important. I can't stress that enough, that the rules that we teach people, and our rules aren't the golden egg of all rules out there, guys. What I'm trying to tell you here is, you've got to learn a set of rules or have enough knowledge to turn your knowledge into a set of rules. Okay, that's the point you've got to get to. It's either you're going to learn someone else's rules or have enough knowledge to build your own and tweak your own over years. Okay, but look, I'll just finish it off pretty much around here, guys. But I'll just finish you off with this thought. Carlo's been teaching people for the last 20 years more. Plus, right? Trader Circle hasn't been around that long, but even before Trader Circle, he was teaching students on how to trade. He's been doing it for a very, very long time. And what our courses are, and they're different to learning about stock markets through a university course or Kaplan. I've gone and done my diploma with Kaplan, but honestly, guys, there's a bunch of knowledge and it wasn't a lot of skill there, guys, right? What Carlo does is he will sit you down and show you step by step what to do. He will teach you and pass on his skills over the years. Now, what's attached to our courses is also a couple of months of support. And that can be ongoing support if that's what you want as well. But what the support does is we can then help you develop your skills. By talking to you on a daily or weekly basis, whatever you want, right? We can communicate through email. Caro's job, along with the other guys on the desk and myself, we're all here to help support traders. That's what Trader Circle is, okay? So I'll leave you with that thought, guys. But look, one way or the other, whether you're interested in doing something with us or not, okay, it's irrelevant here, okay. The whole idea of this 3-part webcast series that we're doing here is we're seeing a lot of new traders hit the market, okay, especially through the cheaper platforms, especially because of COVID-19 and the pullbacks had a lot of people talking about markets now. If you can take something from our 3-part webcast, it's this. The 3 pillars, okay? You've got to have a set of rules in picking direction, have a strategy in mind, whether it's just buying equity or using a derivative, and you've got to, really importantly, have some risk management around what you're doing as well. So if you can take that from this, we've done our job here, right? And we're happy, okay? But look, yeah, I'll leave it there, guys. We've gone an hour and a half. I know your brains are probably full now. So I'll let you go and have some dessert if you've already had dinner, or go have some dinner if you haven't had some yet. But yeah, I hope you enjoyed the session tonight. There's plenty more to come next week. We'll just do a quick Q&A, and then we might finish things up there.
So one of the questions was, Tim, which I think you're good to answer, but you might have answered actually. You could have got into AGL on the 4th of September with support at 1450-ish. So did you address that?
No, I don't think I did even see that.
It's from Paul Loring.
4th of
Paul?
September, was it? 4th of
The
September. 4th of the 9th. 4th of the 9th.
4th of the 9th.
Yeah, see, okay, so you've got a bit of a bullish signal there, right? But what was one of the number one things Cara kept talking about was trade with the trend, and at that point the trend was down. You may have considered something there at that point of time.
Also, in fairness, if you had traded it and bought a call option, and you were out the next day with some form of discipline, you still would have made money.
Yeah.
So the answer is yes, but yeah, we typically don't like to trade against the trend, as Tim said.
Yeah, look, it comes down to your conviction as well. But if you did get in and out very quickly there, you probably would have made a little bit of money. But look, you picked up on one part of what we've taught you there, okay, which is great. But just depending on how you would visualize that at the time.
Yeah, you've got to use it, what you're talking about, in conjunction with the other aspects of the analysis, basically.
Yeah.
I think is what Tim means.
Yeah, so the only thing that would have probably stopped me there would have been the fact that this was downtrending, right? Got lower peak than the previous peak, lower trough than the previous trough, came back up, gapped back down again. The other thing that you can see on this chart, I'll probably lay mention that we haven't mentioned tonight. See how it's gapping down like that? It means there's something serious going on with this company. Okay.
That was the report, yeah.
Yeah, we didn't report well. You can see the mixed sentiment through here. Every single day, the bars are sort of sitting in the middle of the range. There's no conviction in that bullish move. Pulled back. This was the first conviction day, but I don't like the behavior of the stock, right? Why would I trade at that point of time? Traded at this point of time because what's the behavior? It's clear. There's a clear trend. It's moving in a clear, precise way. I like the trend line. We're sitting in a very nice pattern. One thing I did say before was, there's plenty of stocks to trade. Just find something that has got a nice pattern to it. And for me at that point of time, that was a nicer pattern. That's for sure, because I had quite a few touch points along that trend. So there's just stuff like that. And look, sometimes you'll have a stock that fits most of your technicals, but there's a couple of things that just sort of go, oh, you know what, I don't really like that too much. I'll go find something better, right? And that's kind of how the technical analysis works. Where it's to the eye of the beholder sometimes too, right? You might look at that and say, that's fantastic. I really like that. I still think it's going to have quite a few days up, and I might disagree. And that's what trading's about, right? That's what makes the market move. I was
going to say, Paul also asked if we use derivatives for downtrends and conventional share purchases for uptrends. So I interpret that as, do we use derivatives for bearish trades, and do we buy the stock for bullish trades?
We'll cover that in a lot more detail next week. But for now, yeah, look, there's absolute flexibility. So I use derivatives in bullish and bearish trends, or uptrends and downtrends, okay? And I also buy stock, okay? There's different strategies for different markets, right? So if the market's trending in a certain way, we might choose to use a certain strategy because of certain reasons, right? Which is way too much to explain in tonight, and we'll cover that a bit more next week. Absolute flexibility in strategies. We're not stuck with just using derivatives for downtrends.
We did show you tonight as well, obviously a derivative used to take advantage of a bearish move on AGL, but we also showed you a derivative on Wally Limited, which is a bullish position. Instead of buying the stock, we've taken a derivative position to make money on a rising stock. And we've even showed you a strategy which it may seem unconventional to perhaps someone who's used to shares, where we don't really mind if the stock goes up or down too much, but that it holds a particular key level using derivatives. So we use derivatives in all different types of market conditions, and that's really the advantage, and that's actually really why we use derivatives, because they provide that flexibility.
Always have to say this morning to new people with derivatives, guys, don't go out trading derivatives unless you know what you're doing with the three pillars I was talking about before. Just don't do it.
Paul's also asked, can trading software be relied on for this activity? And if yes, to what extent? And I think you've covered that a little bit, Tim, in some ways. Would I be right in saying that? I think what you're asking is, can we use software to rely on this type of trading? And you can see we lean pretty heavily on the software that we use. Can you program your software to do it? The answer is probably yes. And I think, in fact, one of our clients has, or a couple of our clients has. Should you do it? That's kind of in the eye of the beholder. Tim made a good point before, following on from the point that I made earlier, which is that technical analysis is hard to quantify when you're drawing your lines. Easy to quantify in other areas, but having that human element, we still believe is important. So it comes down to the individual trader. And I hope that one of the things that you've recognized tonight is that there's no one way of doing something. There's no one right way of trading, and everyone is different. We don't trade for you. I think I mentioned that at the start, where you can't just give us your money and then we place the trades. The best trader for you is you, we believe, because you can take your own risk tolerances and your conservativeness or your aggressiveness into your account when making your decisions. And that will also come down to how much you rely on the technology to make the decisions for you.
Absolutely.
You asked what's your homework before next week as well, Paul. I don't think there is any. I wouldn't do that to you, to be honest. I didn't like getting homework when I was in school. So I don't like giving it to people. But the problem is that if you're relatively new, then going out there and reading before learning about something properly can actually do a bit of damage as well as do some good. I've always said that there's no argument against learning something or education, but the reason why we've run these webcasts is so that you have a source of information that you can rely on, rather than going out there and trying to guess which things to watch and which things to read. So yeah, you don't have any homework for now. And that's it. I don't think there's any more questions. If any of you got any other questions, please type them in. If you think of anything after the webcast, and you can either wait till the next webcast next Thursday, or you're more than welcome to email us or give us a call and ask that question and we'll answer it. If you call the office, just to remind you, there's only 10 people in the office roughly. There's a very good chance that I pick up the phone, that Tim picks up the phone, that one of the other advisors that you may have heard from before in the past picks up the phone. So there's a good chance you can get onto us. You can ask for me directly. I'm happy to answer the questions. But for now, I think we finish up there. It's 8:40. We've gone way over time. I really appreciate you guys taking the time on your Thursday night to listen to what we have to say. I encourage you to listen to the webcast again before attending next Thursday, just to refresh on what we've covered. And hope to see you all on next Thursday at 7 o'clock.
Fantastic. Thank you, guys. All right. Stay safe. Keep well. Catch you all next week. Bye for now.